So, picture this. Micron is trading at nearly $1,000 a share, just sitting on this massive $1.1 trillion market cap. Now, if you talk to the AI bulls, they'll swear up and down that this is an absolute steal. But talk to the value bears? Well, they'll warn you it's a classic commodity trap hovering right at a dangerous cyclical peak. So who's actually right? Welcome to This Explainer. Today, we're playing financial investigative journalist to cut through all the noise, follow the data, and find the real truth.
Okay, let's dive into this massive contradiction. On one side, you had this high-flying AI hype train pointing to a ridiculously cheap forward PE ratio of just 6.7. Sounds amazing, right? But then the bears are staying super grounded in reality, looking at a trailing PE of 21. You see, memory chips are just notoriously cyclical, and this stark contrast really captures a market that is deeply divided. Are we looking at an AI goldmine, or is this a trap just waiting to spring?
To figure out Micron's true intrinsic value, here's our roadmap for today. First, we'll explore the Micron AI paradox. Then, we'll run the numbers through our ultimate valuation gauntlet. After that, we're digging into the hidden red and green flags, doing a reality check with legendary investors, and finally, we'll deliver our verdict on their economic moat. All right, starting off with Section 1, the Micron AI paradox. This is where insane fundamentals go head-to-head with cyclical gravity.
The sheer numbers powering Micron right now are, well, they're staggering. We're talking trailing 12-month revenue of $90.3 billion, with net income coming in near $50 billion, and that return on invested capital, 67.6%. That is literally Warren Buffett-level efficiency. But here is the massive caveat that we really have to anchor to. Memory is highly cyclical. We're likely sitting right at the absolute peak of an upcycle, which means these insane fundamentals are actively fighting against historical market gravity.
Which perfectly brings us to Section 2, the Valuation Gauntlet, 21 complex models funneled down into one truth. Now, what's really interesting about this data is the wild juxtaposition between these valuation groups. If you assume AI growth just keeps roaring, a discounted cash flow model gives us this dream valuation of up to $1,850. But look at dividends. At just $4.50, we practically throw that out because this company reinvests almost everything right back into its factories. Comparables show this massive gap, kind of hinting the market might already be pricing in a 2027 crash. And finally, the replacement cost is only around $200. What this tells us is that at nearly $1,000 a share, you are paying a massive premium for intangible future AI growth. So, when we weigh all 21 of those models together, our consensus intrinsic value lands somewhere between $750 and $1,200. Let's really slow down and anchor on this math for a second. At almost $1,000 today, Micron is technically fairly valued, but if you're buying at fair value in this specific range, you are sitting on a very dangerous knife's edge. To actually justify the top end of that range, Micron requires absolutely flawless execution over the next few years. Moving on to Section 3, hidden red and green flags. This is the crucial stuff that we like to call the media blackout.
Stepping away from the hard math for a moment, let's expose the footnotes that Wall Street loves to gloss over because, let's face it, they don't fit nicely into a quick soundbite. First up, the red flags. Days inventory outstanding has crept up to 123 days. In the memory chip business, high inventory usually means oversupply is building up and price cuts are looming. Second, they have a massive $27 billion capital expenditure this year. If demand softens even a little bit, all those shiny new factories suddenly become a huge liability. Add in a negative free cash flow of $121 million, and honestly, you can see a storm brewing here.
And this brilliantly illustrates exactly what we're talking about. Just look at the frightening disconnect between their aggressive spending and the actual cash being generated. You've got this towering $27 billion in capital expenditure compared to a tiny deficit in actual free cash flow. Now, aggressive spending is usually spun as future growth by the media, but as smart investors, you've got to ask yourself, what happens to the return on this massive investment if the memory cycle turns south? But hey, it's not all doom and gloom. Let's pivot over to the hidden sunshine, the green flags. First off, Micron has $22 billion locked in through strategic customer agreements with take-or-pay clauses. That is a massive financial safety net. Second, they have these huge historical losses that they can use to drop their tax rate to an incredibly low 14.5%. And third, the total addressable market for high-bandwidth memory is projected to top $100 billion by 2027. Throw in $30 billion in cash and almost zero debt, that balance sheet is an absolute fortress.
I really want to emphasize one specific green flag again, though, that 67.6% return on invested capital. It's just an extraordinary efficiency metric. The financial media usually totally ignores this because, it's a boring accounting metric that doesn't make for a dramatic headline. But for anyone serious about evaluating business quality, turning capital into profit at this rate is absolute gold.
All right, let's move into Section 4, the Legendary Investor's Reality Check.
So forget our complex models for just a minute. Let's bring in the ghosts of investing past to act as our jury. First up, the father of value investing himself, Ben Graham. His formula gives us a fair value of just $297. With a net current asset value of only $29, Graham would probably need smelling salts looking at today's valuation. His verdict is a harsh, definitive rejection. To him, this stock is purely speculative, not value-oriented.
Next, we have the growth at a reasonable price legend, Peter Lynch. Now, Lynch would see Micron's price-to-earnings to growth ratio sitting at a ludicrously cheap 0.04, which absolutely screams buy. But there's a huge dilemma here. Lynch famously hated cyclical memory stocks because he knew that 500% earnings growth can vanish into 100% loss overnight when the cycle breaks. His verdict? A conditional pass. It's tempting, for sure, but maybe just too dangerous.
Let's move to and see how this builds with Warren Buffett. We know Buffett would absolutely love that 67% ROIC. It easily beats his hurdle rate, and he'd adore their pristine fortress balance sheet. But looking at their owner's earnings of around $49 a share, the price tag is just way too high. He'd love the underlying business fundamentals, but totally hate the premium price and the cyclicality. His likely decision? Stay on the sidelines and wait for a crash.
And that brings us to our final section, Section 5, the moat and our final verdict.
So the crucial point is really understanding Micron's economic moat. It relies heavily on two main pillars. First is cost advantage. They're literally one of only 3 companies on Earth capable of manufacturing DRAM memory at this massive scale. Second is switching costs. High-bandwidth memory is physically glued into the architecture of modern AI chips. Once NVIDIA designs a processor around Micron-specific memory, it is incredibly expensive and painful to switch suppliers. Because of this dynamic, Micron's moat is actually expanding as AI takes over.
Synthesizing the math, the footnotes, and the expert heuristics, here's the definitive takeaway. Micron is fairly valued. It is a phenomenal company, but fundamentally, it's a cyclical commodity producer desperately trying to rebrand itself as an AI growth compounder. At $1,000 a share, the market is essentially pricing in a perfect coin flip. On one side, you have unprecedented pricing power through AI. On the other, a massive inventory buildup and a CapEx nightmare if the cycle crashes. The math points right to fair value, but those footnotes are warning us of a brewing storm. In the memory chip business, cycles make millionaires and bankrupt them in equal measure. We've made sure to perfectly cover all the key points for you today, so now I want to leave you with one critical question. Is the AI revolution so powerful that this time is genuinely different, or are we just late to another classic memory cycle? Weigh the evidence we've laid out and decide for yourself. Thanks for joining me on this explainer, and keep learning.